Okay, so this is the second lecture from chapter 18. We're hopefully going to finish up working on lease comparison, lease buying comparisons, and move on to talking about the valuation of whole firms. So we worked last time on a relatively simple example. Let me get my Excel going up, and I'm going to run back over that example. Okay, so you should see my Excel right now. I'm going to blow it up a bit. And I'm just going to review what we did last time. Just get everything. Okay. So last time we said, if we have this option, we're going to buy, I don't know what it was, a piece of equipment, right? And we have the choice of either purchasing the equipment or leasing the equipment. So to purchase the equipment and it's a 2-year project, so year 1 and year 2, right? And so we were going to purchase the equipment in year 0 at time 0. And then we were going to take out a loan in the amount of the lease. So we're working on our cash flows here, right? So we have a negative cash flow because we have money going out to purchase the equipment. And then we have simultaneously money coming in from the bank in the form of a loan, right? We had, and we're isolating, because this is a project, we're isolating, we're not paying attention to anything that's not relevant specifically to this project. So it's a pretty simple P&L kind of that we're building here. So we've got a loan. If we have a loan, we have interest expenses. And our interest expenses were going to be 10% of the amount borrowed. So that was going to be 100. So our interest expense is going to be 10% at the end of each year. And we worked last time, we said, okay, we just refresh. If you take out, if you borrow money and pay interest, that interest reduces your taxable earnings. And so therefore you wind up with a tax savings from interest. Right? And so if this firm, I think this firm we said was going to be have a 40% income tax. Oh, got to make the interest expenses is negative. So I'm just going to. All right. So interest expense should be negative because it is a cash outflow, and the tax savings from the interest is positive. It reduces the interest expense. Okay. And then at the end of the year, 2 years, we're going to pay off our loan. So when we pay off a loan, it's a negative cash flow. And then we have depreciation going on, right? Depreciation. And if we fully depreciate this asset, then it's going to have, and the asset cost us $100,000. If we fully depreciate the asset, then we're going to have a depreciation of $50,000 per year. Sorry, this is going to be the, let me correct that. This is not depreciation, but tax savings from depreciation. And so if we depreciate our $100,000 asset over 2 years, right, and we do straight line, well, each year we're going to get $50,000 in depreciation, and the tax savings from that is going to be 40% of that because our tax rate is 40%. So we have a depreciation shield, right, which is equal to the amount of depreciation times the tax rate. So our taxes are reduced by the amount of depreciation. Why are they reduced by the amount of depreciation? Because remember, if we made, say, $100,000 and we had $50,000 in depreciation, the 50,000 in depreciation is an expense. So 100 minus 50 gives us 50,000 in taxable income. We would pay 40% of that in taxes. This $50,000 in depreciation reduces our tax bill by $20,000, which in this case. So this is the same. Okay. And then we simply did our net cash flow was the sum of each of these columns. So when you sum up for this project, this very simple project, if we were to purchase the equipment, we would have an cash outflow of 100,000 when we purchased the equipment. We would have a cash inflow of 100,000 when we got the loan for the equipment. The interest expense each year is 10,000 on our loan. So we have to pay the bank 10,000. So because we're paying the bank 10,000, that's a negative number. So that's a cash outflow. And then, there we go. That's what I wanted. And then because the interest expenses reduce our taxable income, we have a tax savings from paying that interest. So we pay less taxes. We pay, and so to calculate any tax savings, all you do is take the expense times the tax rate. So in this case, there's an interest expense. We multiply the interest expense times the tax rate. That gives us, in this case, it was $10,000 expense. We get a $4,000 savings. We had $50,000 in depreciation per year because we have a $100,000 asset and we're depreciating it over 2 years. So a $50,000 depreciation, 50 times 0.4 is 20,000. So we have that $20,000 inflow. At the end of the life of the project, we have to pay back the loan. So we have a $100,000 outflow because we're paying back the loan at the end of year 2. So all these cash flows add back up to each of these, right? So we have cash flow of 0 in years at time 0, cash flow of positive 14 at time 1, and a cash flow of negative 86 at time 2. So then we can calculate the present value of the cash flows. Well, the cash flow from this one, right, is itself. The cash flows from these we have to carry back. And we said that we were going to use a 6% discount rate, right? Because our borrowing rate is 10%, but because we have because we get a tax savings from our interest, paying our interest, the effective tax rate, right? The effective amount of interest we're actually paying is minus 10 plus this 4. We're actually only paying $6, $6,000 in interest on our loan. Right? So we take that negative 6 and divide it by the 100. Right? We're only paying a 6% rate. So we're going to use the effective interest rate of 6%. Positive 6%. So we're going to discount each of these cash flows back to the present. At 6%. So this one, right, doesn't have to be discounted because it's itself. This one has to be discounted 1 year. So I'm going to take that divided by 1 plus my interest rate, right? And that's worth 13.2. And then I'm going to discount this one 2 years. So divided by 1 plus the interest rate raised to the second power because it's 2 years. And so I got negative 76. So the total here is the sum of all 3 years. So the present value of the cash flows, if I finance this, is negative 63. And let's just do that. And then the lease option was we were going to have lease payments in time 0 of 55,000. Sorry, not in time 0. In time 1 of 55,000 and time 2 of 55,000. Well, a lease payment is an expense. So what do I do with an expense? If I have an additional expense, I'm going to have a tax savings from that expense. So the tax savings from lease payments is going to be equal to, well, it's going to be positive because it's a savings. So I'm going to make that negative times 0.4. So I'm going to take that lease payment of negative 55. Why isn't the 50,000 included? Depreciation. Okay, Ariana, I'm just seeing your comment. That's back up here, right?
Yeah.
Okay. So the depreciation isn't actually a cash flow, right? And so we're only interested in cash flows. Can you do the PV of the CF again? Yes. So the depreciation isn't counted because it's not actually a cash flow. If we did that, if we included the depreciation, we just have to add it back again. So, I mean, I could do it in the sense of, so it's a little bit different. I guess I could do it, but I'd have to take it away and then add it back. So that's why I'm not including it. Jisoo, so I've got, so you're asking, can I do the PV of the CF again? So I'm actually doing the PV of each individual CF. So the total, so maybe right way to say it would be total PV of CFs, 63. So the PV, so at time 0, any cash flow you have at time 0 is going to be itself. Everything else we've got to bring back to time 0. So this one, I'm taking the net cash flow of 14 and I'm bringing it back 1 year, right? So I'm using my present value of a future cash flow. So the future cash flow is 14. It's happening 1 year from now. So I have to bring it back 1 year. So I divide the future value of the cash flow by 1 plus the interest rate. So 1 plus 0.06. This cash flow, 86, negative 86, is happening 2 years from now. So I take the future cash flow of negative 86 and I divide it by 1 plus the interest rate, the discount rate, raised to the second power because I'm bringing it back 2 years. Okay. So now I've got my time 0 cash flow, I've got my time 1 cash flow and what it's worth at time 0, and I've got my present value of my time 2 cash flow, right? So what it's worth at time 0, and then I just add the 3 together. Does that make sense, Jisoo? So could you explain the rest? The rest of what? Yeah, we're getting there. Okay, we're gonna, I think, so we're not quite there yet. All right, so, okay, so now we're in the lease. So this is the buy option. Down here is the lease option. Okay, so we could buy the equipment for 100,000, right? And we have these associated expenses and savings if you buy it, or you could lease the equipment. And so this lease arrangement is kind of weird in the sense that, and I'm borrowing this from the book. So, and in a minute, we'll do a more accurate lease example. But basically, in this example, you make your lease payment at the end of the year. So at time zero, if you lease the equipment, at time zero, you have no cost. You, at time one, at the end of time of year one, you pay $55,000. And at the end of year two, you pay $55,000. Now, any expense that you incur has the effect on your net income or your taxable income is it brings your taxable income down. So if your taxable income comes down by $55,000, then you're going to pay less taxes because your taxable income is lower, right? So if I had, say, $100,000 in income and I had a 40% tax rate, I would pay 0.4 times 100,000 would be 40, right? But if I have 100,000 in revenues and then I pay 55,000 in lease expenses, then my taxable income is going to be 45, and then I pay 40% of 45, which is 18, right? So if I don't have that $55,000 expense, I'm going to pay 40,000. But if I have that $55,000 expense, it brings my taxable income down to 45. And so I'm only paying tax on 45 instead of 100. Okay. So what's the difference between if I pay tax on 100 or if I pay tax on 45? Well, the difference is 40 minus 18, or 22, which is what we're doing here. So to calculate the tax savings of any expense, you simply take the tax rate times the expense. So because this is framed as a negative number, I have to do negative the tax rate times the expense. But you just got to remember, if it's a savings, it's going to be a positive, right, as opposed to an expense. Okay. So I spend 55, but I've got a tax savings of 22. And that's it, because I don't have any other expenses. So my net cash flow in this case is equal to the sum of each of these columns. So 0 and minus 33. So now I'm going to do the same thing as I did up here. I'm going to use the same, get rid of that. I'm going to use the same, so PV of each cash flow, PV of CF. So PV of my time zero cash flow is itself. The PV of my time one cash flow is going to be the future value of the cash flow divided by 1 plus the discount rate. And we said the discount rate is going to be 6%, so 1 plus 6%. And then the second cash flow happens at the end of the second year. So I'm going to take the second cash flow divided by 1 plus the discount rate raised to the second power, because this one's being brought back 2 years as opposed to 1 year. Okay. So now I have the total present value of the cash flows for the lease payments of 60,000. So relatively simple question here is, which would you rather pay, 60,500 or 63,333? So that, would you rather pay less or more? And obviously you'd rather pay less, right? Because this is a pure expense. If I can buy the equipment and take out a loan and pay the loan and have a total cost of 63,000, or I can lease the equipment and have a total cost of 60,500, right? So the final thing we do is the net, and so we're doing that kind of in our head, net advantage to leasing, which is simply the present value of the cash flows associated with leasing minus the present value associated with purchasing the equipment, And what you see is we have a net advantage to leasing of 2.83 or $2,830. So all I did was I took the present value of the cash flows from the lease option and subtracted from that the present value of the cash flows from the purchase option. So the net advantage here is that I have a $2,830 advantage from leasing versus buying. Okay, so this is what we worked on last time. And I didn't do it in Excel, I did it, just manually. So that was a review. Is everybody with me? Anybody need me to do something again? The main thing to keep in mind is whenever you have an expense, expenses reduce taxable income. So the key here is if I see something that's an expense, like a lease payment, right, or an interest payment, I'm going to take that number and multiply it by whatever the interest rate is. So if the interest rate was 30%, I would take the interest expense times 30%, and that would be a savings. So it's going to be a positive cash flow. Okay, I'm not seeing questions. So this was a review. So now I want to make a point. And that point is up here in the buying option. Copy this and put it right next to it. I'm going to take out everything that's not related to the loan. So I'm going to take out the actual purchase of the equipment, and I'm going to take out the depreciation savings. And now all that's left is I take out a loan, I pay interest on the loan, I have tax savings from the interest payments that I pay on the loan, and then I pay the loan back. Okay, I've extracted out of this the actual purchase of the equipment and the depreciation, the associated depreciation savings. What is the effect then of this portion of the calculations that we did on the present value of the purchasing option? So the present value of the purchasing option is $63,330 or $33. It's probably $63,333, I imagine. So there's no, right? Yeah, I've now taken out the purchase of the equipment. Let me go back and copy that again. I'm going to decompose this into two parts. Now I'm going to take out, so in the top half, right, in this version, I took out the actual purchase of the equipment, right, and all I focused on was the present value, the effect on the present value of the purchase arrangement with as a result of the loan. Down here, I'm going to take out the loan. That's going to mess my thing up. So I'm going to hard code this 0.06. So I'm going to take out the loan. So I'm taking out the 100, right? I'm taking out the expenses from the interest rate, I'm taking out the savings as a result of the interest, and I am taking out the paying back of the principal. So now I've extracted the loan, the interest expenses, the tax savings from the interest expenses, and the payment back of the principal. All I have left is the purchase of the equipment and the depreciation savings. And you'll notice I wind up with $63,333 down here as the present value. So what's happening? Well, what I'm trying to show you is that the financing portion of the problem, right, has no impact on the present value. If you're discounting at the effective interest rate, then the loan is going to be a wash in terms of present value, right? You take out $100,000 in a $100,000 loan, you pay a net of $6,000 per year, you pay back the loan at the end. When you discount those cash flows back, they're exactly equal to 100. So 100 minus 100 is 0. So what's my point? My point is that when you do a calculation for a purchase, you don't have to include the loan or the interest expenses or the tax savings or the payment back of the principal. In other words, you can just delete this whole piece. Let me just copy, paste the value here. I can just delete out this whole section that has to do with financing. What went wrong there? Oh, didn't take out that. So the whole financing portion can be just deleted. And you can focus just on the purchase of the equipment and the effect of the depreciation. Okay. In other words, it's a net present value, right? As a net present value from the financing of 0. Remember, we did net present value, and we say, all right, the net present value is the future value of the cash flows, or the present value of the future cash flows, excuse me, the present value of the future cash flows added to the initial investment, right, which is usually negative. But we've kind of got the values flipped, so positive and then negative cash flows. And so you get an NPV of 0. So when you do a problem like this, you can ignore the loan, the financing portion of the purchase. The main thing you have to remember to retain and not forget is the effective post-tax discount rate, right? So if I pay a 10%, if I have a 10% interest rate and I have a 40% tax rate, then my effective interest rate is my interest rate times 1 minus my tax rate, right? Which is a formula we've seen about a zillion times, right? It is after tax equals before tax times 1 minus t, right? Just remember that. So the effective tax rate, the effective discount rate, the effective interest rate, which will be your discount, will be your discount rate. So the effective interest rate is going to be the before tax amount, which in this case is 10%, times 1 minus the tax rate, which in this case was 40%. So 1 minus 40% is 0.6. So 10 times 0.6 gives me 6%, which is my after-tax rate. If it was 30%, it would be 1 minus 0.3 or 0.7. And so the after-tax discount rate would be 0.7. All right. All right. I know that's a little confusing. I'll share this with you after we're done. So simple lease. We're going to do a more complicated lease example now, and that's going to be based on the Word document that I sent you earlier. So you want to pull that up. We're going to look at a project that's going to be a 4-year project. we're going to, in our purchase option, so the purchase option is going to be to purchase the equipment for $200,000. We're going to have to pay a maintenance contract on the equipment of $2,500 a year, and it starts the day we buy the equipment. So that means that we're going to have to pay that maintenance contract the first time at time zero. We're going to have a tax rate of 40%. The equipment actually has a 5-year tax life with an expected salvage value of $20,000 at the end of 4 years. And the firm uses MACRs, which we've avoided using so far, but I'm going to give you MACRs down here. So if you scroll to the bottom of, sorry, not down here. Yeah, there we go. There, you should be able to see that now. So I gave you the MACRs depreciation rate. So we'll work with that in a minute. Okay, so here's our information. For your project, after-tax borrowing rate of 6%. Equipment purchase at $200,000, maintenance contract at $2,500 a year, starts at the time of purchase. Tax rate of 40%, 5-year tax life, expected salvage at $20,000. We're going to use MACRs, which is this. So I'm going to push that back over here. Okay, so for the purchase option, we're going to buy equipment. It's going to cost $200,000. So minus 200, right? And that's going to be at time zero. Also at time zero, and then we're going to go 1, 2, 3, 4. Also at time zero. We're going to have our maintenance contract. So maintenance. And that is going to be a $2,500 expense. And I just used the word expense. So whenever you hear the word expense, you should be thinking about tax savings, right? So tax savings on maintenance. So how much tax savings on maintenance am I going to have? How am I going to get it? So if I pay $2,500 in expenses and I have a 40% tax rate, good, 2,500 times 0.4, okay? So I can make that a positive number because this is going to be a savings times 0.4. So I'm going to have $1,000 in tax savings. Okay. So that's all that happens at time zero. Just get caught up with my notes. Now, let's go over here and do a depreciation schedule. At time 0, 1, 2, 3, 4, 5, and 6. So we have a purchase of the equipment of $200,000. Then we're going to apply MACRs. So I'm just going to go down here and copy this out of the table that I gave you guys. Hopefully this will work. So how much depreciation do I get in each year? Well, equals this times this. Good, it's going to work. So using MACRs, MACRs allows modified, it stands for modified accelerated, um, I'm blanking. Basically what it does is it allows you to take depreciation earlier than a straight line would allow, right? So if this was and this was 5-year equipment, you'd be able to take $40,000 per year, right? So it'd be 40 like that. What this allows, what Mackers allows is in year one, you take the same amount as you would under regular depreciation, but in year two, you take dramatically more depreciation than under straight line would allow you. So what this allows the firm to do is get depreciation savings earlier than they normally would. So I'm just going to delete this. That's the straight line version. So this is how much depreciation our firm is going to be allowed to take on their $200,000 piece of equipment each year. Okay. So we're ignoring financing because we can. That was the point of the last exercise we did, right? So we're going to ignore the fact that they're taking out a $200,000 loan at 10%, and that they've got, so they would then have $20,000. So we could do that, right? We could say, oh, loan, and don't do this now. Loan 200,000, right? Then you could say interest expense would be 0.1 times 200,000. Then you would say savings from interest would equal, that'd be negative. And then savings from interest would be 20,000 times 0.4, right? And we would go along doing all that. And at the end, we'd pay back the loan, right? But what we would find is it would all kind of cancel out because we discount all that portion of it back. We would discount that portion back and it would net out to zero. So the effect of the financing on our purchase has a net effect of zero as long as we are applying the same discount rate as the effective interest rate is. And that's actually how we come up with our discount rate. So of course we would be applying the same discount rate. So what else do we need to include for this, right? We bought the equipment, we're paying maintenance. So we're going to have maintenance costs happening each year. And they happen at the beginning of each year or effectively at the end of the prior year. So what am I going to do with these maintenance expenses? I carried that out. What am I going to do with these maintenance expenses? The contract, a 4-year contract, 4 years of maintenance expenses every year. There's a little bit of a trick here. I pay my maintenance expense at the beginning of each year for the year. Effectively, on the last, I pay the maintenance effectively on the last day of the prior year. So how far out am I going to copy that? So I'll pay maintenance expenses at the end of year 1 for year 2. And then I'll have a savings at the end of as well. So I'm going to pay $2,500 at the end of year 1 for maintenance in year 2. Then I'm going to pay my maintenance bill for year 3 at the end of year 2. Then I'm going to pay my maintenance bill for year 4 at the end of year 3. Then I'm going to pay, wait a minute, am I going to do that or what? What do I do here? I know Emily's outside enjoying the sunshine, so she's probably not paying attention. What about the rest of you? Am I going to have that expense in year 4? Where's my chat box? Disappeared. Okay. Oh, okay. Sorry, my chat box disappeared on me. I didn't see you guys were responding. So I'm sitting here like, why aren't you talking? You don't have maintenance in year 4. Good. Right. I don't have that expense in year 4. And the reason is I paid at time 0, I paid for 1. At time 1, I paid for 2. At time 2, I paid for 3. And so at time 3, I paid for 4. I'm stopping I'm not going to pay any maintenance fees in year 4 because I've already paid for year 4 at the end of year 3, and we aren't going to run the project in year 5. So it doesn't matter. So Elizabeth, your question was, does the 4-year contract include year 0? So I'm paying at time, it's not right. So it's kind of time 0. So year 0 or time 0 is today, right? And so I write a check for maintenance that's going to cover from, say this is January 1st. I'm writing a contract. I'm paying $2,500 to cover the maintenance expense from January 1st to December 31st. December 31st ends at the end of year 1. So this is like December 31st. So this is like January 1 of 2020. And this is 31 December 2020. And then this is 31 December 2021. And this is 31 December 22. And this is 31 December 23, right? So I pay my maintenance bill effectively on January 1st of 20 for all of 20. I pay my 21 maintenance bill on December 31st of 20. I pay my 2022 bill on December 31st of 2021. And then I pay my 2023 bill on December 31st of 2022. It's kind of like paying your rent, right? Your landlord expects you to pay your rent on the 1st of the month, not on the last of the month, typically. And it's pretty rare that a landlord says, oh yeah, you can live there for free and then just pay me at the end of the month, right? So that's what this is. All right, so we've covered maintenance expense. So what's left? Well, depreciation. So tax savings on depreciation. So depreciation happens at the end of each year. So my tax savings for depreciation is going to be 40% in this case because that's their tax rate. It's going to be the tax rate times however much depreciation expense I can take. So in this case, I'm going to take 0.4 times 40,000. And then here I'm going to take 0.4 times 64,000. And then here I'm going to take 0.4 times 38.4. And here I'm going to take 0.4 times year 4's depreciation. So that's my depreciation savings. Now, what other cash flows do I have? Well, I said in the problem that I'm going to have a salvage, right? And it's going to be 20,000. But this is a taxable, this is a for-profit firm. So that means that they have taxable any sales that they have are taxable. So we have to figure out, and this was a mistake a bunch of you made, was you forgot to calculate whether this was a taxable event or not. Well, it is a taxable event. You didn't calculate the tax effects of the event. So let's look over here and figure that out. If this equipment was fully depreciated, which we know it's not because it's a 5-year, even if we were doing straight line, which we're not, but even if we were, it would still have another year's worth of depreciation left. But in this case, because we're doing Mackers takes a 5 years depreciation and actually extends it to a 6th year. So how much depreciation have we accumulated? And what does the IRS say the equipment we own is worth? Well, according to the IRS, we bought the equipment for $200,000, and then we took $40,000, $64,000, $38,000, and $23,000. So our book value is going to be the purchase price, right? Which if we were doing this on a balance sheet, so remember our balance sheet from way back in chapter 4. We'd have gross PPE, which is the original purchase price of $200,000. And then we would have accumulated depreciation, which is what I'm doing here, right? This is all the depreciation we've taken. So this is the accumulated depreciation. So we'd have 200,000 minus whatever accumulated depreciation we'd have. And that would give us our net PPE value, or this is also known as the book value of the equipment. Well, the book value of the equipment is $34,560. So according to the IRS, the thing that we are selling at the end of year 4 is worth $34,560. However, we're selling it for $20,000. So if you have something that the IRS believes is worth $34,000 and you sell it for $20,000, do you have a tax gain or a tax loss? According to the IRA, the IRS, not the IRA, the Irish don't care about you. According to the IRS, have you just made money or lost money? Right. So you have effectively you have a tax loss, right? So if you have a tax loss, the IRS gives you a tax credit, which you can apply to future years, or you can bring it back prior years. If we were doing it, if you really want to learn about this stuff, you need to go over to the Paul College and take a tax course, and that'll put you to sleep real fast. So so in this case, because the book value is less than the sale value, so we're selling it for 20. So our loss is 20 minus 34. So we have a loss of 14,560 according to the IRS, right? So what is our tax savings? Well, we're going to get a tax refund of 0.4 times, well, I'm going to make it positive, so 0.4 times our tax loss. Right. 58,000. So we're 5,824. So we're getting that back. And so now we can do our net cash flows. So now we just sum up the columns. Okay. So the cash flows as a result of purchasing look like so. And so what is the present value of the cash flows? Well, it's going to be, I'm going to just use the NPV now. So I have an outflow of 201, right? Plus, and I can use the NPV formula. And I told you that the discount rate is 6%. And then here are my cash flows. And so we have a present value of the cash flows of 126,980. So by purchasing this equipment, we wind up spending, we have a total cost to us of 126,980. So now we need to look at the comparison to the lease option, right? So lease, and we said, so if you go back to the okay, Ariana, what does it mean to have a 5-year tax rate, but when there are only 4 years, does that have an effect? Yes. So the effect is that we have not fully depreciated the asset. So the asset, if we held onto it for in this case, we'd have to hold on to it for 6 years to fully depreciate it. If you sell something, so if this was straight line's a lot easier to talk about. Yeah, I'll show you the formula. Well, I'll show you the formula in a second. So with straight line, it's a lot easier to think about. With straight line, we'd have 1, 2, 3, 4, 5, right? So we'd have 200,000 divided by 5. So we would take 40,000 per year. So if we sold it at year 4, we would have 4 years of depreciation for a total of 160. So our book value, right, would be the 200,000 minus the accumulated depreciation. You'd have a $40,000 book value. Okay. So if you sold it at year 4 under straight line depreciation, you'd actually have an even bigger loss because we'd be 20 minus 40 instead of 20 minus 34.5. So does that make sense, Ariana? All right. So it's simply, if you sell something before it's fully depreciated, then you're going to have a book value greater than 0. If you sell something after it's fully depreciated, then you're going to have a book value of 0. So if we sold this thing in year 6 after it had been fully depreciated for $20,000, then the book value would be 0, and we would have a gain of 20 minus 0, $20,000. All right, Jisoo, yep. So with this formula, what I did was I took the net cash flow at time 0, which is itself, and then instead of doing each cash flow manually by saying, okay, this one is 14.5 divided by 1.06. This is 24,100 divided by 1.06 squared. This is 13.8 divided by 1.06 cubed. This is 35 divided by 1.06 to the 4th, right? I could have done that. Instead, I just used the NPV formula, which gives me the present value it's the present value of an annuity, right? So this is an annuity here. Well, not really an annuity. It's a series of cash flows, future cash flows. Good, Jisoo? All right. So now the lease. The lease option is we pay $57,000 a year in advance, and that's it. No maintenance cost, no depreciation because we don't own it. So lease payment. And if we're paying it in advance, we're paying it at time zero, so minus 57,000, right? And we pay it through to year 3, right? We pay it 4 times at the beginning of year 1, the beginning of year 2, beginning of year 3, beginning of year 4, right? And so that's it, right? Except that's an expense. And so that has a tax savings associated with it. So the tax savings, again, is minus, I'm going to do minus 0.4 because it's a positive number, is 40% of whatever the expense was. So we have a savings of $22,800 per year. So our net cash flows are the same in each year. And then in year 4, they're 0, right? Because we have no expenses. So the PV of the cash flows is going to be the cash flow at time 0, because that's already, we already have the present value of the cash flow at time 0. So we don't have to do anything to it. Plus the present value of the future cash flows, which we're going to discount at 6%. So we've got 3 future cash flows, and the 0 doesn't count. So we have the present value of the lease option is $125,617. Right. So now we can do the net advantage to leasing. Now, net advantage to leasing is equal to the present value of the cost of leasing minus the present value of the purchasing option. And we have a positive now of 1,362. And you could just eyeball that and see, okay, it's cheaper to lease than it is to buy, right? Because this is a pure expense, so we want to have a lower number. So we did a slightly more complicated, version than we did on the first one, but not that much more complicated, just a little longer life. And then we included the MACRs, right? I can never remember how to calculate MACRs, so I just go to a MACRs table. I'm embarrassed to say I always screw it up, so I just go to the MACRs table. So if I give you a problem that involves MACRs, I will give you the table, and you'll calculate it. But if this was done with straight line, you would have done it the same way. The tax savings from depreciation would have just been 40% of 40,000 every year, right? Going forward. So it would have been 16 all the way across. That would be the only difference. How are we doing on that one? That makes sense? Everybody following? Got one last little thing to do with lease. And it's got to do with the now. So if we're good with that, like I said, I'll send you the file so you can look at it. All right, 1 second. Let me just check something. All right. Okay, so the last thing we're going to do is you can also do, instead of doing a comparison of the now using, you can calculate the net advantage to leasing instead of using the present value and effectively the NPV, you can instead do an IRR calculation. So you could say, does this give me a higher percent return? But in order to do that, you have to calculate the now slightly differently. So if we take the, what we need to do is, I'm going to give myself a little more, I guess. Cash flow from leasing and cash flow from buying, because remember the now, the net advantage to leasing is going to be lease minus buy. So I'm going to grab the cash flows for leasing just from right here. Right, so they're exactly the same as this line. And I'm going to grab the cash flows for buying up here. And I'm going to say, what's the net advantage of leasing? So I'm going to take the cost of leasing minus the cost of buying. Right? So it's $167,000 less in year one, or at time zero, to lease than to buy. And I'm just going to copy that across. So again, this is just lease minus buy. Each cell is just lease minus buy. And now I could calculate the IRR, right, of the lease versus own. And I get a return on this leasing, right, or an IRR of 5.62%. So our usual rule when we're using IRR to decide whether we should do something or not is we want an IRR greater than our discount rate. In this case, we invert that rule. We actually want, if you want to favor leasing, you want to show that the return from leasing is less than the required rate of return. So in this case, you want an IRR of less than the discount rate. So this is less than 6%, right? So that means this is a go. And it kind of works the same way, right? You want to have an IRR greater, when you use IRR normally, you want to have an IRR that's greater than the discount rate. When you do NPV, you want to have a positive NPV. So, and if you have a investment that has an IRR that's greater than the discount rate, you will always have a positive NPV. In this case, as long as if you have an IRR that's less than the discount rate, you will always have a positive NAL, NAL. So that's the last little tweak to this understanding. All right, you got a couple problems to practice with that. Let me save that. Okay. That's the first half of the chapter. The second half of the chapter, so we've done our lease versus buy. The second half of the chapter gets into looking at valuing a business. which I think I'm going to leave for next time. I'm going to talk to you instead. I'll wrap up today by talking to you a little more about leasing. So let me just change my camera here. And then we can spend the whole time on Monday talking about company valuation. So stop share, change my video. All right, so we've done a financial analysis, right? Non-financial motives for leasing. So there's a couple of reasons why you might lease, even if the financials don't support it. So number one is ability to bear obsolescence. So obsolescence, what does that mean? That means that, oh, how did I get the 160,000? Sorry, Kat, I missed that. Hold on. All right, let me jump back. All right, this 160,000 here.
I figured it out.
Oh, okay, all right.
Thank you.
No problem. Okay, ability to bear obsolescence. So, obsolescence means that your technology gets old, right? And and then you don't want to use it anymore. So, for example, probably many of you have like iPhone 10s, or I think there's a new iPhone that just came out. I don't know. So, you know, I'm still operating. You guys are gonna laugh at me. I'm still operating with an iPhone 6. Right? So, and like I think my wife has a 9, or I don't know. My kids all have 8s and 9s and 10s. iPhone SE, is that a cool one? Yeah, iPhone SE. All right. Anyway, so I'm using technology from 2015. So so and it still works. So it's not obsolete, but it gets the job done. So that's which is why I haven't bought a new one yet. But there is technology that does eventually becomes obsolete. So like you can think of probably computer programs or video games that maybe you had when you were a kid, and then you bought a new video game system, and your old video game, discs or cartridges or whatever you had weren't compatible with the new video game system. So that's technological obsolescence, right? So if technology is rapidly changing, small organizations often can't afford to be stuck with really expensive equipment, and so they would prefer to lease because they can get out of the lease more easily than they can sell the piece of equipment and replace it. So people who want to, one of the motivations, so like my in-laws lease their car because my father-in-law likes to have a new car every like 3 or 4 years. So they lease their car. They're down to one car because they're older. So they lease their car, and then and then when the lease runs out, they go and they get a brand new car. As you all know, I drive a 16-year-old minivan. So I obviously don't care about such things. But if I was maybe young and single and some very cool HMP major looking, out on the dating scene, I probably wouldn't want to drive a 16-year-old minivan. But since I'm an old married dude, I can drive around in a 16-year-old minivan and not worry about it, right? So I can bear the obsolescence. My in-laws don't like to bear the obsolescence, and so they choose to lease. Organizations do the same thing, right? If you want to have the newest and best equipment all the time, it's more convenient to lease than it is to buy. So The next is ability to bear utilization risk. So you guys seen that movie, The Field of Dreams? Anybody know that one? All right. Okay, because I worry, because I make these cultural references and you guys are like, I have no idea what you're talking about. You know, that clearly happened back in the Stone Age. Larkin would know. That's true. Larkin always knows. She always gets my references. I have to appreciate Larkin. So the line from Field of Dreams is, if you build it, they will come, right? And so it's kind of a weird movie. He builds well, it's like 30 years old, so I guess I can't say spoiler. If you haven't seen it yet, spoiler alert. Close your ears for a second, right? He builds this baseball field in the middle of nowhere, and out of the corn stalks come all these famous the ghosts of famous baseball players, right? So if you build it, they will come is kind of the line here. So, but in the real world, a hospital, if it decides to invest in a new technology, so it builds this new technology with the hopes that if they build it, the patients will come. If they build it and the patients don't come, then they're going to lose a whole lot of money. So if they want to build something, but they can't afford to take the risk that if they build it, the patients won't come, then they're worried about utilization risk. So the lease that we talked about, like the per click lease or the per use lease, where you pay a fee every time you use the equipment. So if you got a per use lease on an MRI machine, every time you did an MRI scan, you would accrue a bill to the leasing company. So if you were like, hey, I'd like to get an MRI for my little tiny hospital up in the North Country, but I'm not sure that I'll get enough utilization to justify having the equipment, the big expense of having the equipment. What you're saying is, I'm concerned about utilization risk. So instead of signing a lease, or instead of buying equipment, or signing a lease where it's a monthly bill to have the equipment, instead I would sign a lease where I pay a per click fee, right? And so that transfers the utilization risk from my hospital, right, or my clinic, to the lessor, right, to the people who are leasing my equipment. And then a third reason is ability to bear project life risk. So it's kind of related to version 2, which is, what if we build it, right? We build build this thing thinking that we're going to have years and years of demand, and in fact, what happens is the demand, we burn through all the demand, and the demand dries up. Well, if the demand dries up and we bought the equipment, then we're stuck with the equipment. But if we lease it, then there's usually a cancellation clause in which we can say, hey, we're breaking our lease, we're invoking our cancellation clause. Come pick up your MRI machine. We don't want it anymore. Right? So that reduces the risk. Fourth is borrowing limits. And this is, you're a small company and you can't get a loan, right, to buy maybe you can't get a loan to buy a MRI machine. Well, GE says, hey, no problem, you can't get a traditional loan from a bank. We'll just lease the machine to you, right? So we effectively will be your bank. We will lease the machine to you. And maybe there's a clause in there that, at some point you can buy the equipment, at a reduced price. right? So lease to own is an option. You may have heard of that phrase, where like you lease and if you decide to buy it, your lease payments are converted over as if they had been mortgage payments all along. All right, and the fifth one is lower risk of bankruptcy. And this actually, instead of favoring all of these really kind of favored the lessee, the person or organization leasing the equipment. This one favors the lessor. Why is that? Well, if they lease the equipment to you, instead of say making they sell it to you, and this would presume that they finance. Not only do they sell it to you, but they finance you, right? So if GE sells you an MRI machine, and then GE Capital finances it, there's some risk that if you go bankrupt, it's hard for them. They may not be able to get the equipment back. If you lease it from them, the equipment is still technically their equipment, right? Since you didn't buy it, you leased it. And so if you were to go into bankruptcy, a judge wouldn't look at the MRI machine as property of your clinic, right? The judge would say, well, it's actually not yours. You have to just flat out return it to GE. So that is the last reason. All right. So Monday we will pick up and do business valuation. It's fairly straightforward, though. Well, I don't know. It's a little bit mind bending because but it's work we've already done before. It's all based on the DCF, discounted cash flow model, that we've already done from, what was it, like chapter 14. So we'll just brush the dust off that model, which I think a bunch of you are going to be refamiliarizing yourself for anyway. So it should be fairly fresh in your mind when we come back. All right, so that's it for class today.